Hello, everyone. Welcome to FM with Sir Evans. In today's session, we will discuss the 8th and last competency in the syllabus of ICA Paper 2.4, Financial Management. So we'll look at mergers and takeovers. So when we talk about acquisition is when one company acquires the other and becomes the parent company, while the other is subsidiary within the group. Merger is an amalgamation of two companies of approximately equal size. The objective of a takeover and acquisition should be consistent with the overall objective of the companies involved, which should be to increase the wealth of the shareholders. Alternatives to acquisition is growing through internal development of the business and growth by means of a joint venture. So we'll look at some advantages of acquisitions and mergers. So with advantages of acquisitions and mergers is one, faster than growth by internal development. Acquisition also gives buyers immediate ownership of new products, new markets, and new customers. It also allows the entity to enter new markets where barriers of entry are very high. It prevents a competitor from making the acquisition, instead making it more competitive, and it results in synergy. Thus, there is cost savings and higher profits. However, there are some disadvantages. It might be quite expensive and it can result in loss of proportional ownership of the entity. It's also difficult to bring different organizational structure and management styles together. And there is a possibility of a clash of cultures of these different entities coming together to form one. Now, there are certain criteria for choosing an acquisition target. It should match with the strategic aims and objectives of the entity, the cost and relative size of the target, the opportunity and availability for the parent company, and also any potential synergies that are applicable in the final company. So when we talk about synergy, it's the concept that the combined sum of two separate entities after a merger or acquisition will be worth more than their sum as two separate entities. When two separate entities come together into a single entity, opportunities might arise for increasing profit. Synergies might, however, be divided into three categories. We have the revenue, cost, and financial synergy. So revenue synergies, it refers to increases in total sales revenue following a merger or acquisition. By increasing total combined market share, it occurs where an enlarged company is created that is able to promote brand more effectively or bid for large contracts. How about cost synergies? We are looking at the reduction in costs as a consequence of a merger or takeover. Combined activities reduce costs such as warehouse facilities, staff office premises, etc. However, this may be difficult to achieve due to often long and complex process of combining the activities. And financial synergy, it refers to the ability to raise finance in a cheaper way. The enlarged company might have access to financial markets due to the perceived lower credit risk. It is therefore able to borrow from banks at a lower rate of interest. There's been some instances where there is a failure of acquisition. So many acquisitions fail and do not provide the value for shareholders that was expected when the acquisition was made. So we'll look at certain reasons. One, the purchase price paid for the acquisition is often too high. Expected synergies may not occur. Serious problems with integrating the acquired company into the new group due to culture and management style clash. There is insufficient time and attention of senior management in acquiring company to make acquisition operational and financially successful. There's also increased competition that drives down the profit for all participants in that market or industry. And also, whenever there is a takeover, it could be hostile, and we'll look at certain defenses against a hostile takeover. So a friendly takeover is agreed by the board, shareholders, and the management. However, in a hostile bid, board of a target company rejects the offer and refuses to recommend it to the shareholders. It's risky as the bidder does not have access to management information. The most important defense is to persuade shareholders to reject the bid. And you could do that by one, announcing that the company expects to increase its profit substantially in future, hence offer price from bidder is too low. Also announcing an intention to return a large amount of equity to shareholders in the near future by increasing dividend or share buybacks, also explaining future strategy of board of directors for increasing profits in the future. However, when it is uncertain whether shareholders will be persuaded to reject the offer, then we have certain defenses which could be employed. We have one, finding a white knight. That's finding another company who is prepared to make a higher bid. You could also use a poison pill. That's establish a contract where a large liability will crystallize if business is sold, but this may be legally challenged. And also changing voting structure to require larger majority to agree the takeover bid. This can be changed if the change is made. This can be challenged if the change is made after the bid. Okay. Now, if you are accepting an offer, there are certain considerations. We have the offer price, which you look at, a purchase consideration, the job security, and any alternative options such as more attractive offers. And due diligence. This is a process which attempts to reduce the risk associated with a transaction. It's an investigation of a business or person prior to signing a contract. So due diligence will attempt to achieve one, confirm the accuracy of information and assumptions on which a bid is based, and provide an independent assessment and review of target business. Also identify and quantify areas of commercial and financial risk and provide assurance to the providers of the finance. So we have financial due diligence, which is a review of the target company's financial position, financial risk, and projections by examining financial statements, management accounts, and their estimates prepared. And also we have legal due diligence, where you focus on any legal matters which might be relevant to the value of the company or its continuous success in the future. For example, hidden warranties, securities given on assets, legal dispute break clauses, and so on and so forth. And we have instances of reverse takeover. It's a transaction in which an entity acquires another entity, and the shareholders of the acquired entity end up with control of the combined entity. It is used by a private company to become publicly traded without going through an IPO, initial public offering. The legal acquirer is often described as a shell company or SPAC, Special Purpose Acquisition Company. Benefits include being a traded entity without cost and delay of going through IPO process. Shares also being more valuable. You have greater access to capital markets, and shares will be used to acquire other companies. So when we come to valuing mergers and acquisition, the companies who are involved will need to agree on the valuation and offer prices of the shares. So in a takeover, the acquiring company needs to decide what price it is prepared to offer for the target company. And directors of the target company need to decide whether the offer is acceptable and whether it should be recommended to the shareholders. So shareholders in target company need to decide whether they are willing to accept the offer made for their shares. So where the target company is listed, then the current share price is a useful guide for the valuation, and offer must be higher. But where it is not listed and the value of the target company is, however, estimated, evaluation is required for the equity shares in the target company and not the company as a whole. So valuation is an art, not a science, because the final price is often agreed through negotiation, and judgment is applied to decide how much to pay. The only correct valuation is the price that the shareholders of the target company accept. Factors to consider in pricing a takeover include: one, we have the synergy, the risk exposure, real options such as any future opportunities, financing, which include how to raise such finance, and the valuation assumption that's around the whole valuation process. And some valuation methods which we can use: we have the net asset value of the target company, the market-based valuation, where you use the estimates of future earnings or dividend; cash flow-based valuation, where you use discounted cash flow of expected future returns from the acquisition; and expected value added model. So when you are talking about the types of acquisition, we need to consider the risk profile. So acquisition might impact the risk profile of acquiring company, and the two aspects to the risk profile are: we have the financial risk, where there is a change in the financial gearing due to financing method, example, debt, and also the business risk, where it's operating in a different industry or market sector, and there is a change to the business risk profile of the entity. So we'll look at we'll categorize acquisitions based on the impact on the risk profile and influence, and based on this impact, we'll look at the valuation techniques to be used. So for a type 1 acquisition, we are looking at it having no impact on the risk profile. So the acquisitions that impact neither the acquiring company's exposure to financial risk nor to business risk. So for this one, we have the appropriate valuation method. We have the asset-based valuation, market-based valuation method using dividend or earnings. You can also consider the cash flow models. As there is no change in the risk profile, the company's carrying cost of capital can be used in the valuation. For a type 2 acquisition, it affects the exposure to financial risk, but not to business risk. So with this, we use the adjusted present value model. And for the type 3, is affecting both financial risk and business risk. So we consider the iterative valuation procedures. Now we look at certain methods to finance the acquisition and the measures. So purchase consideration. So in a measure, one company might acquire the other company by issuing new shares. A takeover might be paid for by issuing new shares to the shareholders in the target company, who will then become shareholders in the buying company after the takeover. So cash to finance a takeover bid might be obtained from existing cash resources, or by issuing new shares to other investors, or by borrowing. The purchase consideration, both the total purchase price for a takeover and the nature of the purchase consideration, it could be in the form of share, cash, or debt securities, are usually subject to negotiation in a friendly takeover. And all share consideration. So when a takeover is financed by issuing new shares as the purchase consideration, either the shareholders in the buying company or shareholders in the target company will gain value at the expense of the shareholders in the other company. If there is synergy and total annual earnings and cash profits increase, then the total value of the business should be expected to increase and add value to the shareholders. So cash or debt financing in purchase consideration. So another way of providing extra value for shareholders in a takeover might be to pay for the acquisition in whole or in part with either cash, which is financed by borrowing, or debt securities. The benefit of paying in these ways is that there is a tax relief on the interest cost. The target company shareholders might want to be paid in cash. Therefore, they will offer to buy the target company shares for cash. So thank you very much. This is the last session for paper 2.4 financial management. And I believe that with the other resources available on the channel, you would be able to be more prepared for the papers. So thank you once again, and I'll see you in another session. Bye-bye.